Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, Matt Markiewicz, Head of Product and Capital Markets at Tradr ETFs, and Ed Rosenberg, Head of ETF Products at Russell Investments. We're here to discuss outlook for the second half of 2025 and how to exposure to those themes. It is great to have a full boat with us this afternoon. Welcome to Trade Talks. It's been an interesting first half for 2025, that's for sure. Ed, the market continues to be resilient despite some of the fear and fundamentals.
Yeah, I mean, it's definitely been resilient, but if you look at what's happened, we think the third quarter is really critical to how it's going to play out for the rest of the year. I mean, especially with GDP, the tariffs all coming into effect, the market's been exceptionally resilient to everything, from random tweets all the way through to the tariffs being put into place. But we think the third quarter is where everything sort of hits the fan and the economy really reveals itself to what it's going to be going forward.
Yeah, it seems to be the theme during earnings calls, or what we're hearing from a macro perspective, as well as we look towards the second half of 2025.
Yeah, well, we don't really have a house call
right.
per se, a trader. We can just make the products that people use to express the views. Earnings season for a lot of our high tech, unprofitable growth companies just starting to hit. Quarters are looking good. Guidance is being raised. I know it's backward looking, of course, but for us, the volatility is great, and I would expect we'd see more of that. I don't know what the house view here is in Nasdaq for.
Yeah, we're going to get into the products in just a moment because I'm curious to get your view on vol, but really, Michael, that's the key when this all starts to show up in the data, and certainly where you sit on the Nasdaq side of the house as a U.S. economist, the kind of data that you've been following has been in debate for a while this week.
Yeah, and I think we've really just gotten the first hints of tariffs impacting the data in June, when we saw inflation for core goods was picking up, especially if you're looking at things that are more exposed to tariffs, things like appliances, toys, home furnishings, stuff like that. And then when we got the PCE report, we saw the same thing with real spending, where you saw actual spending was only up 0.1% in June. But if you look at those categories most exposed to tariffs, again, appliances, furnishings, they were down 0.6, 0.7% that month. So starting to see some sensitivity from consumers there. With the jobs report, that was a big news item on Friday, adding only 73,000 jobs. Not a terrible number, but the hope was for more like 100,000. But then the big news was the downward revision of 258,000 jobs to May and June. I think it's going to be interesting to see where things go from here, because that was the period of kind of peak uncertainty of tariffs. So it would make a lot of sense if companies were thinking, hey, I'll hold off on hiring a little bit right now, see where things go. Now we're starting to get a little bit more clarity on tariffs. 10% if you run a surplus, if the U.S. runs a surplus with your country, 15% or higher if you have a trade deficit, and then 40% for transshipments from China via a third country. So we're getting more of that clarity finally, I think, on tariffs.
I feel like this is a really good lesson in how dependent corporates, economists, and so forth are on the data and making those kinds of decisions.
Yeah, it's really been, the first half of the year, the buzzword was uncertainty,
right.
I think, and we're starting to get more of that clarity, which I think is really going to be helpful.
Yeah, and Max, I would agree that, continuing to see that Mag 7, the large cap, mega cap tech, carry the market here just because of the weightings that it has within the indexes.
Still working. Earnings have been pretty good. Obviously, we're seeing multiples are still a bit expanded, but those earnings are still growing. I think the blended rate now is about 10% for S&P 500 earnings growth. So again, double digits. I think this is the third quarter in a row of double-digit earnings growth. So still positive. That trade is still working. Software is really starting to pick up. So obviously, there's still some pockets of weakness, but that large cap, mega cap trade is still working, and those companies are succeeding, so that we're still going to see money flowing into there. They haven't obviously been impacted by tariffs. That's not really going to hit them. And I think worst case scenario was that April 2nd announcement, and everything's since been kind of dialed back. So I don't think there's a ton of worry on that side. We'll see now obviously how that plays out over the rest of the year. But so far, it's been kind of just continue to operate through everything versus changing, as every headline comes out. Everybody's been operating through, and again, earnings have been pretty solid.
Yeah, it's interesting, Ed, because we had a number of global strategists on the show over the past couple of weeks, and they're still saying that the U.S. is a place to be.
Yeah, I mean, maybe. That's the thing, because depending on what these tariffs do and some other things that are going into effect, how much do they slow the economy? And if you think about what's happened part of this year, I mean, Europe, for example, had a growth spurt compared to the US earlier this year, and as the dollar keeps weakening, one of the things we think is the whole globe's going to slow down. But we also think that the US is going to slow down more than places like Europe. And so Europe might be the place to be to invest for the second half of the year and maybe a little bit beyond as we go forward.
Well, in fairness, though, it was outperforming in the first half of the year as well because it was a valuation trade.
Yeah. But it is a valuation trade. But now when you look at what's going to happen in the US, how much do the tariffs slow the US versus the rest of the world? Right? And we think that is going to be a critical piece. So that third quarter is really going to tell us. But one of the prevailing thoughts we have is that the US is going to slow more than Europe. Everyone's going to slow. Everyone's going to get hurt by this.
Right.
But as the US slows, we think Europe's going to grow a little, or I should rephrase that. Europe's going to slow down less than the US, so Europe might be the place to be to put some money as we go to the second half of the year.
Yeah, and Matt, you had said that volatility could sometimes be a good thing for the market.
Yeah, for us, we operate almost 20 levered products. The market still has a huge appetite, especially self-directed traders, for these type of products. Around certain events like earnings or tariff announcements around particular countries. The narratives that we see in kind of the stocks in which we have products, they're all in, as I mentioned, like growth industries. AI infrastructure, aviation, electric vehicle aviation, a lot of AI type of companies. So it's a little bit different than the industrial. The numbers for Archer Aviation, an eVTOL company, aren't really showing up in GDP numbers. So it's I don't want to say they're outliers, but these are the types of companies that, again, still unprofitable by and large, and I don't say unhurt by tariffs, but they're not really impacted the way that some massive industrial companies, semiconductor companies are, which are trading highs kind of all right now too. So yeah, volatility is very good for our business.
Yeah, and Tesla is your largest ETF.
Yeah, our short Tesla fund is our largest ETF at about $400 million, and one of the most actively traded ETFs in the U.S. every day. It's only meant to provide 200% negative return to the daily price of Tesla, so it's not something you want to hold over the longer term.
So it's like a shorter term.
Short-term swing trading, looking
right.
at the charts, or trading around Tesla earnings or monthly sales numbers, what have you. But because there's always a lot of chatter coming out of the head of Tesla, no matter whether it's on one platform or the other, it's always in the news. But yeah, it keeps things interesting.
Well, what's one of the benefits? Why not just write or buy options on the underlying or short it rather than going into the ETF? What's the benefit of the ETF?
Yeah, so leverage ETFs provide an investor with a vehicle to avoid potentially confusing options contracts. You don't have decay, right? In that, if you want to hold it for longer than a day, and then margin account, right? If you're going to short stocks or buy stocks on margin, if you want to amplify a view on a stock, your brokerage platform charges you for that, right? That's all inherent in the price of the ETF and the management fee. So it's a little bit of a cleaner way to kind of do that. And when you have a margin or options, most investors are just really confused by kind of how all the terms work. And this way, just where you bought it at, and you can get out kind of wherever you want. It's very transparent.
Yeah, and Ed, that's really what the attraction is by doing this via wrappers.
Yes, I mean, the ETFs give you exposure to whatever you want, which makes it easier than trading individual securities or trading the options. I mean, think about trying to get exposure to international markets if you're just an investor buying individual stocks.
Right.
So having the ETF, especially the way we do it, is unique to the marketplace. We combine the best managers in the world into one product. And so by doing that, no one has to even research the managers and go find different funds. We're putting them together for you.
I mean, it's more cost efficient. It would be nearly impossible for an individual investor to replicate that portfolio. It would be too expensive.
Correct. To replicate the portfolio or just to go find each one of the managers. They may not be able to find them, or you'd have to invest in 5 or 6 different funds, and we're combining it into one for them.
Yeah. So I think, Max, part of this is to see how it's eventually going to broaden out. I mean, the Mag 7 can only lead the market so far. Right?
Yeah.
I mean, the trend's a trend until it's not anymore, but there are going to be opportunities at some point.
Yeah, we're obviously the back end of the year is going to be important. Q3, we've started to hear a lot more coming out of the Fed, narrative shifting to, okay, with these revisions, you're getting a lot more doves are, okay, we could be cutting rates, probably going to get 2 this year is now what's being priced in, another one in June. That cut July wasn't really going to happen. I don't think anybody expected that, but September was kind of a question mark, and now that seems to be really getting baked in, that we're potentially going to get 2 cuts now for the back half of the year, help some of those smaller caps and mid caps that have been a bit underweight in portfolios and underperforming given the Mag 7 performance, which even the Mag 7 has started to broaden out between those 7. So maybe that tailwind for some of the small caps, which have been really lagging. That's been the narrative for, it seems like 2 years now, 3 years. We've been talking about that trade, the catch-up trade of small caps, Russell 2000 versus the S&P 500, waiting for those small caps to outperform, and that just hasn't happened. That gap has not narrowed at all. It's been the same trade that's been working. Like you said, though, until it doesn't. But if we get some of those rate cuts, when you start seeing those headlines, you really start to see the small caps start to outperform. It's kind of been that tailwind everybody's been waiting for to potentially shift, take those profits out in some of the larger caps where that have really been working. But until we get that, it seems like the trade is going to be continue full steam ahead. And the mega caps valuations have not really been such a question. You know, even you see some today in software space where they're still growing. Those multiples are pretty wild, but the growth is still there. The earnings are still there, and you're not going to get. There's not a ton of companies that can really compound 30%, 40% annually in their growth. So people are willing to pay up for that. We're seeing, a solid outlook here in the IPO market. We have a few coming that are going to be pretty large. The digital asset space is obviously continuing to grow, and that's really in the headlines. So there is demand. There's a lot of risk appetite. So I think until that runs out of steam, small caps might underperform. But again, that back half, if we get those cuts, that could be a real trade for the back half of the year.
Companies like the Mag 7 too, they're incentivized to invest from a tax perspective.
Yep.
So Michael, Brian pointed this out on our desk yesterday that this is somewhat similar to what we saw in 2024. We ended up nothing in July, but then ended up getting those couple of rate cuts in the back half of the year in September. If we get 25 bips, 50, let's even call it 1, right? Is that going to move the needle in the housing market as an example? I feel like that's what really needs to open up for the consumer.
Yeah, I think the hard thing is if we've seen, the housing market tends to move more with the 10-year. And so, sure, Fed rate cuts typically do translate a little bit into the 10-year, but it's more the 2-year that moves with the Fed moves. So it might not solve that problem necessarily, or the help isn't going to be, we're not going back to 0, right, from the Fed, so we're not going to see 3% mortgage rates anytime soon. So I think the relief that people are looking for probably is going to take a while to keep working its way, like we've been saying for a few years now.
Well, let's say sellers are outnumbering buyers now. The survey just came out for the housing market. I think it was 500,000 more sellers than buyers at this point. It's the widest margin they've ever had. I think buyers. I think if we get under 6%, get into the kind of 5.5-ish range, buyers might change their mind and say, okay, I don't think we're actually going to get back into the 4s. Maybe this is the opportune time because there is a supply. We've been waiting for supply now. Supply at the right price, as we've talked about plenty of times here. There can be supply, but if the numbers just aren't right, it doesn't matter what the supply is if the sellers aren't willing to lower their prices. But if we get some of those cuts and we see the 10-year start to fall, I know there wasn't a great auction today, but we have the long bonds tomorrow. But if that starts to come in even a bit, get under that 6% mark, I think that's a bit of a psychological threshold for some buyers to step back in. The supply is actually starting to come online now, which we haven't had forever. So. Yeah. I think you might find a better mix again the back half of the year if we get some rate cuts that hold up. Whereas we saw the last rate cut, rates backed right up right after.
But
they cut and backed up.
Historically, 6 to 7%. Michael, keep me honest here. It's a decent number. It's not like it was 18, 19% like it was in the 80s. But we have to call a spade here. When you look at inflation in terms of insurance cost and how taxes have went up, people who have existing homes are being priced out. Because if your insurance costs go, 25, 30%, that's part of the affordability issue as well. Sure. I think cutting rates isn't the black box solution.
On top of that, the 6 or 7% mortgage rate that people had, 20, 30 years ago, well, home prices are up 50% in 5 years.
Right.
So the size of the mortgage that you're taking out at 6 to 7% is just so much larger than it was when the average home price was way, way lower the last time we saw these rates. Part of the issue, right, is that we had such low rates that people could afford the monthly payment at a low rate for a more expensive home, but at these prices, it's not as
it's almost double your payment. When you and I moved in our respective homes at 3% level, there's no way. Once it's at 6, 7%, it doubles your mortgage.
Changes a lot.
The other issue you have with the housing market is a lot of those starter homes that people had, they're just not putting them on the market. So people who want to buy homes in like Gen Z want to start buying homes, there's less supply of those, and you have the bigger homes out there, which they can't afford to begin with.
Right.
Because the people aren't stepping up their homes because they just can't afford the rates.
Right.
And the valuations with how much they've jumped.
But then you also have millennials getting into homes, their generation later than
Correct.
previous generations. So there's another shock too, where what's the expression? House rich, cash poor.
Yep.
You save all this money, you have your 20 to 30% down payment, then you pay, then you have closing costs and moving costs and so forth. And oh, by the way, you don't call this super when something breaks at your house.
Correct. It's kind of like living on the West Coast, right?
Right.
Certain cities, you don't budget 25% for your home, they budget 45, 50% of their income.
Right.
And so, but doing that all over the nation, most people aren't used to that. And so they're not ready to take that step. Because if you think of like Gen Z, what do they value most? They value their time and vacations and time away. They don't want to be stuck in a house. They want to be out doing
experiences
something.
and so forth.
And so if those starter homes where they can't afford aren't coming up because people aren't upgrading, that's also the problem.
Yeah. Well, I mean, it's good for the economy, though, when you have people spending money on experiences and consumer discretionary.
If they can afford it at this point.
If they can afford. Oh my gosh, this is a grim look.
Well, isn't that part of the
Gen
sort of
Z,
the
right?
discussion from a
Yeah.
rate cutting standpoint? Are we cutting rates because inflation is moderated, subsided, or are we cutting rates because the economy is bad and we kind of need the lower rates to kickstart the economy a little bit more?
But the
I think
economy's
that's the
not
question.
in that bad as of now. We don't know what it'll look like after third quarter. So, and I think that's kind of the
But I think
balance.
that's why everyone got spooked by Friday's numbers and the revisions, as you noted. I mean, are we going to cut rates in September? I think the odds are 90% right now for a rate cut. Is it just to kind of placate the administration, or is it because the economy is starting to teeter, starting to waffle a little bit, and we need the lower rates to help things along, whether it be housing or other types of lending?
Yeah.
I think it's a question that a lot of people are asking because it is going to affect investment direction for
I
the
think
rest
that's
of the year.
25 versus 50. 25 is kind of okay. We're moving in this direction versus if we get a surprise 50 basis point cut. I think that might sound some of the alarms of okay, what's happening in the economy that we were doing this.
So maybe the market
Starting to
trades
get more
down if they cut 50 in September?
I think a 50 would be a bit of a spook. Yeah,
Imagine if it's cut more though.
Right.
Like
That's what I'm saying.
that-
Or it could, what if it is
be a
1%?
I mean, we think obviously we think there's 2 rate cuts coming this year as well, but it seems like it's hard to put a handle on the number, the percent they're going to cut.
Yeah.
Right? Is it just a quarter? Is it 50? I mean, I think I read an article, the president wants 300 basis points, right?
Yeah.
How much of a shock would that be to the system overall? So it's a question of, I think if they cut and lay out the right plan, even if it's 50, if you lay out the right plan as to why, I think the markets will be resilient. If it's cut and we're not explaining it really well,
Right.
then I think the economists that sit in your shoes are going to have a hard time justifying and understanding where we're going and what you're missing, and then I think everything falls.
Yeah. And this goes back to the conversation we were having before that, 50 basis points, is it really going to move the needle in terms of opening up the housing market and affordability? There are bigger policy issues here in terms of affordable housing, and perhaps some state AG should be talking to the insurance companies that do business within their states. That's a conversation for another time, but I think we need to, there's more to this than just rates. All right, guys, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.